Okay, class, today we're going to be talking a little bit about inequality across the world. So, first, let's talk about the gap between the rich and the poor. We divide this into four strata, where low income countries are mostly sub Saharan Africa, Pakistan. Lower middle income countries are China, Caribbean countries. Upper middle income are Brazil, Mexico, Saudi Arabia. And high income are the US, Singapore, France, Japan, Kuwait. So, this is a table of indicators of economic welfare in the four groups. So, the average GDP per capita in low income is about 635. In lower middle income, it's about 2,300. In upper middle income, it's about 7,300. And in high income, it's about 44,000. So, the data on this is kind of old, but you can see how life expectancy as you increase in income increases. So, over time, generally speaking, the world income gap has narrowed. So the income of high income countries and previously middle income and low income countries are on a convergent path. So here's output per capita in selected countries between 1960 and 2010. Here's some more countries. These are Latin America and Asia. See, probably the biggest growth right there is either Singapore or Hong Kong. So there's some structural features of developing countries. So what causes poverty is a difficult question, but there's some similar characteristics. First is government control over the economy. A country that has a very strong government control over the economy is likely to be less developed. So that's going to include having high restrictions on trade, direct control of production and industries, high level of government purchases relative to GNP, direct control of financial transactions, and reduced competition that this government control has. It reduces innovation. It has a lack of market prices. So secondly, most developing countries have unsustainable macroeconomic policies that cause high inflation, unstable output, and employment. So, a really common factor among countries, especially Zimbabwe, has been seigniorage, which is when you pay for goods and services by printing more money. This is called debasing your currency. This leads to really high inflation. And so, as a result, Zimbabwe historically has had the second highest incidence of inflation in the world. I think first is Hungary back in the 1950s. High inflation reduces the real cost of debt that the government has to repay and reduces the real value of repayments for lenders. This is costly to society. You have unsustainable output, and employment is also costly. The third is a lack of financial markets that allow transfer of funds from savers to borrowers. Fifth is they have natural resources or agricultural commodities make up an important share of exports for many developing countries. So in Russia, petroleum is the sole export. Malaysia, it's timber. South Africa, it's gold. Colombia, it's coffee. Number six, attempts to circumvent government controls, taxes, and regulations have helped to make corrupt practices such as bribery and extortion a way of life. For example, in Colombia, while the highest legal export is coffee, there's also really large amount of black market trade in drugs and So here you can see a trend line between corruption and per capita income. As your income goes up, you can generally see a trend that corruption goes down. Another common characteristic for low and middle income countries is that they have traditionally borrowed a lot from foreign countries. So other countries will invest a lot of money in investment projects, and most of them fail, or the borrowed funds are used primarily for consumption purposes. This is true especially in the case of foreign aid. As a result, countries have defaulted on their foreign deficits. So the economics of financial inflows to developing countries. National savings minus investment equals what we call the current account, where the current account is approximately equal to the value of imports minus the value of imports. So here's cumulative current account balances of major oil exporters compared to developing economies and compared to advanced economies. A financial crisis may involve a debt crisis where there's inability to repay sovereign or private sector debt. You can also have a balance of payments crisis, a banking crisis, so a debt crisis is when governments default on their debt, and sometimes when a government thinks it's going to have a debt crisis, the likelihood of them defaulting will actually increase. So it's a self-fulfilling prophecy almost. So, following a debt crisis, sometimes you'll also have a banking crisis. Or you can also have a balance of payment crisis. These can all occur together, and each can make the other worse. If people expect a default on sovereign debt, a currency devaluation, or bankruptcy of private banks, each can lead to the other. So we have alternate forms of financial inflow. The first is a bond finance. Second is a bank finance. Then we have official lending. This is from like the World Bank or other development banks. We have foreign direct investment and portfolio equity investment, which is when a foreign investor purchases equity for his portfolio. Debt finance includes bond finance, bank finance, and official lending. Equity finance includes direct investment and portfolio equity investment. So we have the problem of original sin. So sovereign and private sector debts in the US, Japan, and the European countries are mostly denominated in their respective currencies. But when poor and middle income countries borrow, their debts are almost always denominated in US dollars, Japanese yen, or euros. This is called original sin. So when a depreciation of domestic currencies occurs, liabilities that are denominated in domestic currencies do not increase, but the value of the foreign assets increase. This is all fairly self-explanatory. So we have the debt crises of the 1980s. High interest rates and appreciation of the US dollar caused the burden of dollar-denominated debts in Argentina, Mexico, Brazil, and Chile to increase drastically. There was a worldwide recession, and there's a fall in many commodity prices. In 1982, Mexico announced that it could not repay its debts, which were mostly held by private banks. So the US government insisted that private banks reschedule the debts. And in 1989, Mexico had a reduction of the interest rate, an extension of the repayment period, and a reduction in the principal. And the same is true for Brazil, Argentina, and the other countries. So, in 1987, the Mexican government implemented reducing government deficits. They reduced production in the public sector by privatizing industries. They reduced barriers to trade, and they maintained an adjustable fixed exchange rate until 1994, which helped curb inflation. And this was called the crawling peg.